For the first time in 10 years, a president of the United States traveled to China on an official visit. Markets expected a signal of stability and strength for the US dollar, but instead, the exact opposite happened. Silver exploded from around $60 to $90 per 1 ounce in just a few weeks. That's a 50% surge in an extremely short period of time. For many investors, this isn't just a rally in precious metals, it's a warning sign that the world is beginning to lose confidence in the US dollar. Inflation in the United States has climbed back close to 4%, meanwhile dollar interest rates are only 3.75%. In real terms, dollar holders are losing purchasing power almost every month. Goods and services are becoming more expensive faster than saving can grow. From European perspective, the situation looks even more dramatic, as many European countries hold US dollar as reserve currency, but this reserve currency is going down due to high inflation and low interest rates, and also it is losing too many currencies, it is just going down. Donald Trump's visit to China was historic for one major reason. No American president had made an official visit there in nearly a decade. The entire world watched the meeting as a potential turning point between the two largest economies on earth. Before the meeting, markets hoped tensions between the US and China would finally ease. Investors expected a reduction in the trade war, less pressure in the technology sector, a strong signal that the US dollar would remain dominant globally. But after the meetings, the official statements were much colder and more cautious than expected. President Xi Jinping reportedly emphasized mutual respect, an end to economic pressure against Beijing, the need for a multipolar world, in other words, a world where the United States no longer dominates the global economy alone. Xi also highlighted greater use of local currencies in the international trade. For many analysts, this was a clear sign that more countries are preparing to move away from the US dollar, especially across Asia, the Middle East, BRICS nations. Meanwhile, Donald Trump focused heavily on trade imbalance, China's competitiveness advantage, fairer trade policies, fewer subsidies for Chinese companies, greater access to American business in China. Trump also emphasized the US remains the most powerful economy in the world. America will not allow its technological or military dominance to weaken. However, markets focus on one key issue. There were no major breakthroughs, no massive trade agreements, and to economic tensions, strong signal restoring confidence in the dollar. That's when investors began moving aggressively into hard assets, silver, gold, commodities, because when the world sees the two largest superpowers unable to fully agree, capital starts searching for safety outside of paper currency. The biggest problem facing the US dollar today is not just exchange rates. The real issue is much deeper. The dollar is rapidly losing purchasing power. Official inflation in the United States is now around 3.8%. Dollar interest rates are only about 3.75%. At first glance, the difference seems small, but this is exactly where the real problem begins. It means, even according to official government data, Americans holding savings in dollar are losing value in real terms. Prices are rising faster than money can grow, and many economists believe real inflation experienced by ordinary people is significantly higher than official numbers suggest. Costs rising rapidly include housing, insurance, energy, food, services, and this creates another major problem for dollar. For decades, the United States benefited from a massive advantage. The world needed dollar for trade oil, normal trade, international financial settlements. United States could print money on unprecedented scale that allowed America to print enormous amounts of money without triggering an immediate currency collapse. But today, more countries are moving away from the system. BRICS nations are expanding trade using local currencies. China and Russia are reducing their dependence on the dollar. Middle Eastern countries are increasingly accepting payments in Chinese yuan. Central banks worldwide are buying gold at record levels. This means global demand for the US dollar is slowly declining, while the supply of dollars remains enormous. And this raises a critical question. If inflation destroys the dollar's value faster than interest rates can compensate for it, does holding cash in US dollars still make sense? The market may already be answering that question, because historically, whenever investors investors lose confidence in paper currency, capital flows into gold, silver, commodities, real estate, and the recent explosion in silver prices could be the first major warning sign that this process is only beginning. One of the clearest signs of dollar's long-term weakness can be seen in its performance against the Swiss franc. For decades, the Swiss franc has been considered one of the safest currency in the world. Why? Switzerland became known for financial stability, low inflation, strong banking credibility, conservative monetary policy, and when investors become nervous about the global economy, money often flows into the Swiss franc. If we look back roughly 50 years, the difference is shocking. Decades ago, $1 could buy well over 4 Swiss francs. Today, $1 buys only around 0.78 Swiss franc. This is less than 1 Swiss franc. That means the US dollar has lost the vast majority of its value against the Swiss currency over the long term. This is not just a short-term fluctuation. It reflects a much bigger story. The gradual erosion of the dollar's purchasing power over decades. During the same period, the United States massively expanded debt, printed enormous amounts of money, increased dependence on stimulus and monetary expansion. Meanwhile, Switzerland maintained much tighter financial discipline, lower inflation over long periods of time, and the market rewarded that stability. For many investors, the Swiss franc became a store of value, a safe haven during crises, a protection against currency debasement. And this comparison creates a serious question for the future of the dollar. The world's reserve currency could lose so much value against the Swiss franc over 50 years. What happens during the next decade if inflation remains high and global trust in the dollar continues falling? Because history shows one brutal reality. Paper currency can survive for a long time, but they almost always lose value when governments continue expanding debt and money supply faster than real economic growth. Despite all signs of weaknesses surrounding the US dollar, there may still be one major reason why the dollar remains dominant, and the reason is the global financial system itself. More specifically, the SDR system controlled by International Monetary Fund. SDR stands for Special Drawing Rights. It's essentially a basket of the world's most important reserve currencies: the US dollar, the euro, the Chinese yuan, the Japanese yen, the British pound. And even though confidence in the dollar has weakened, there is still a strong possibility that the dollar could maintain or even expand its role inside the SDR system. Why? First, oil prices have surged again, and because global oil trade is still heavily priced in dollars. Higher oil prices mean countries need even more US dollars for international energy purchases. This creates constant structural demand for the dollar worldwide. Second, US weapons exports remain enormous. American military equipment continues flowing massively into Europe, NATO countries, the Middle East, Asia, and most of those transactions are still settled in US dollars. In other words, even if confidence in the dollar weakens, the world still needs dollar to buy energy, weapons, strategic commodities. But at the same time, Chinese influence inside the global financial system continues growing rapidly, and many analysts believe the Chinese yuan will likely receive a large weight inside the SDR basket in the future. Why? China's share of global trade keeps expanding. More countries are using yuan in bilateral trade agreements. Beijing is aggressively internationalizing its currency. But here's the key issue. If the dollar and the yuan both gain influence inside SDR, more inside SDR in 2027, someone else will likely lose influence. And many believe the biggest loser could be the British pound. The pound once represented the dominant reserve currency of the old global empire. But today, Britain's economic influence is much smaller than it was decades ago. Meanwhile, the euro's importance inside SDR could continue increasing, especially because the eurozone keeps expanding. Croatia has already adopted the euro. Bulgaria also joined eurozone. That means the economic size and transactions volume of the euro area continue growing. So the future SDR system may become increasingly dominated by the US dollar, the Chinese yuan, the euro, while older reserve currencies like the British pound slowly lose global importance. British economy is shrinking, and this may reveal the real future of the financial system, not a complete collapse of the dollar, but a transition toward a multipolar monetary world, where several major currencies compete for the global global influence at the same time. And if that happens, the era of absolute dollar dominance may slowly come to an end, even if the dollar itself remains one of the most powerful currencies on earth.